In 2015, world leaders met in Paris and agreed on a most ambitious goal to tackle climate change, limiting the global temperature rise by 1.5 degrees Celsius compared to pre-industrial era levels. To meet this goal, we need to have the amount of greenhouse gas emissions released into the atmosphere by 2030 and drive them down to net zero by 2050. Something of this magnitude requires radical changes. There is already a strong push for governments, businesses, and individuals to do the right thing by their environmental, social, and economic footprints. However, it will take time. In the meantime, offsetting emissions today through the carbon markets offers a viable path in the transition to a net zero emissions world. Carbon credits, or offsets as they are also known, are generated by activities that avoid, reduce, or remove greenhouse gases from the atmosphere. For example, activities such as no tillage in regenerative farming and conservation of forests generate carbon credits through emissions removal and avoidance. These carbon credits are then acquired by individuals and corporations, for which reduction of emissions through their activities is neither economically viable nor immediately available. And given the co-benefits embedded in specific carbon projects, buyers of carbon credits not only offset emissions, but also create significant environmental, social, and economic impact in helping developing countries meet the United Nations 17 Sustainable Development Goals, SDGs. Recent reports indicate that in order to achieve the Paris Agreement goals, carbon markets need to grow substantially, up to 15 times by 2030. Our mission at Viridios Group is to contribute toward this growth trajectory and ultimately meeting the Paris Agreement goals through innovation in finance and technology. There is lots to do and little time to waste. Viridios is here to help meet the challenge.
Okay, thanks very much. This is a little introduction to who we are and what we do. I'm sure you're well aware of a lot of what was said in that video because, we're here at New York Climate Week. So I'm sure that video is prepared for numerous new participants across the ecosystem to give them a bit of an explanation of who we are, what we do, and what we contribute to the ecosystem. So with that, I'm just going to pull up the presentation now. And then we can go through that. And please, if you have any questions, you can either put up your hand and I'll try and jump to you, so interrupt. I'm more than happy with that. I like it to be interactive if that's possible. Otherwise, there's also a chat function on the bottom right-hand corner, a little chat box. You can chuck it in the chat box, and if I see something pop up there, I'll try and address it immediately, or we'll address it in a conversation at the end, if that's okay with you. So let me, first time presenting on Google Meet, so just bear with me a second. Right, so I'm going to share. So this is the presentation here. I'm going to go to full screen for you. Hopefully everyone sees the full screen now. I can't see you, so I'm going to assume it's okay. So we're going to present on managing price risk exposure in voluntary carbon markets. Another colleague who heads up, who is the Chief Investment Officer, Marcelo Lebert, will be presenting, I believe, tomorrow in New York Carbon Week as well. So you'll be able to see some more details from him as well. That was an auto move. So you guys all know this, so I'm going to leave this one. Carbon credits, how they work, CO2 avoidance or removal activity, the carbon credit offset is issued, CO2 emitters pay for that effectively. So it's obviously a lot more complicated than that in many ways, but that simplifies it for a lot of the conversations we have, just to frame. So to give you a little bit of a background, Viridios was born in late 2019, essentially. There's sort of an actual date is hard to pinpoint, but at that point, our founders looked at the idea of transacting the voluntary carbon market. They could see the value, charismatic projects that were grossly undervalued, and the need to be able to get true valuation for those projects. And because they saw them as undervalued, our founders come from backgrounds in capital markets. So that is in trading, predominantly in banks. They've traded voluntary carbon markets before. They've traded in compliance markets. We've traded also in rates, bonds, FX, and commodities. I specifically joined the group coming from a physical commodity trading background for over 25 years. So it's physical and financial. So we come together and bring an understanding, I think, around how this market can evolve, because we've all been involved in seeing markets transition through numerous realities to building diversity, inclusion and participation. So going back to that 2019, the problem that we uncovered as we tried to build a fund was that if we were to trade in the voluntary carbon market and work with developers and projects and accumulate credits that we could then on-sell to retirees of those, the end consumers, the corporates, then what is the price? So it's very hard for accounting firms to understand and value a portfolio that we had, also to look at liquidity risk and numerous other problems that we find in capital markets, or challenges we find. So as we looked at this, it became more and more evident that the market in voluntary carbon space, the offset space, really lacked price transparency. So that became effectively the problem statement. And I'll give you this background, and we will lead on to exactly managing price risk exposure in the voluntary carbon market. But this lays the groundwork for where this came from and how the problem was effectively uncovered and targeted. So we put the fund idea on hold, and we decided that for the value to contribute to the ecosystem, and it does solve a challenge for ourselves, but for the whole ecosystem, someone needed to step in and develop a way of finding price transparency and sharing that across the whole ecosystem. It helps everyone from project developers all the way through, and we'll go into that in a little bit more detail. So value discovery is an obstacle and urgent to get capital inflows. Again, we want diversity and both in participation and inclusion across the whole ecosystem. So opaque markets, problem for that. So just 2 seconds. Not sure how that's happened. We just shut down. There we go. Sorry. Sorry. Everyone see that okay? So that's the problem. That gives you a background to where that came from. We know the value of transparency in markets because we've seen it in both financial markets, but also more specifically in commodity markets. And I'll go to that in a little more detail in the upcoming slides, because that's kind of the case study. And we don't need to reinvent the wheel, but there's a significant opportunity in this market that we can contribute. And it aligns to a vision of where this market can get to. And most importantly, the actions that we need in the voluntary market space to contribute to the overall decarbonisation. I've touched on some of these already. Price transparency and benefit. Price transparency, benefits the majority, not the few. Now, when I say the few, when we have opacity in any market, when you don't understand what true value actually is, you get a situation where origination of projects may not even get off the ground. Because if you're working with a local community on any kind of project, be they household devices, be it reforestation, right across the whole spectrum of offset markets, then it's expensive to go through, as we all know, to go through the process of certification. And there's significant challenges there, and that's not a challenge that we solve for, right? I mean, the market is doing a good job at evolving that with a lot smarter people who understand that part of the market much better than we ever will. So we leave it to those to do that. So that certification is expensive. It takes a lot of time. So if you're asking a local community to invest time and effort and potentially money, limited resources, into setting up what may become a certified carbon credit structure, then it's very difficult to do that if you don't know the kind of price you're going to get for it. And so most transactions at the moment are happening bilaterally under what we call an NDA, non-disclosure agreements. So they're very opaque in nature. So those that benefit from a situation like that, and we've seen it in commodity markets for a long time, in nascent markets, is those that can understand what pricing really is. They have the experience. They work with the supply side on a cost-up approach, and they work with the demand side in making it as flowery and as beautiful as possible, right? And I'm talking, whether you're talking opaque coal markets or whether you're talking grain markets. And in this case, we're talking voluntary carbon market projects. But they try and, so that's where the margins come in, because both on the origination side, they don't know what true value is, and on the consumer side, the retiree in the case of credits, they don't know what true value is too. So in between, there is a huge margin that can be made from opacity. But again, that benefits the few. And we believe in transparency in markets to have that inclusion. We want the projects to see the light of day because they understand true value. Once we also understand true value, and I'll go through each one of these in a minute, but I'm jumping around a little bit. Once we understand true value, you can also use capital markets. And I'll just skip down to a message here. Financial institutions, right? Increase funding support. Once they know what true value is for a project, then they can start putting more funding support into the ecosystem. So that's a very important part of inclusion and diversity. So, and on the retiree side, it helps for the corporates to understand what is true value in the different opportunities they've got to invest in the voluntary carbon market, whether they be working with an originator, developing a project, or whether they be working in the secondary market, for example, and buying available credits already issued, and everywhere in between. So we generally get more projects being realised. We get value decisions when competing. So royalty payments, for example, if we're trying to protect a forest from deforestation and you're competing with a logger, for example, who's given a live cash bid to a minister, then for that land and for that forest. And if you're trying to convince them to keep the forest standing and avoid deforestation, and you say the credit's worth more, it's very much like, you know, what is that worth? So transparency in markets and value help you have that conversation with that minister to save that forest from loggers, because you can now show them an independent mark on what it's worth standing, as opposed to being very wishy-washy on what the true value of that forest is. So, you know, from that perspective, it helps. End of day marks facilitate capital markets participation. Capital markets at the moment, many funds, family offices, banks, etc., all in the capital market space, find it very difficult. They all are chasing carbon exposure, but the only place they can really go at the moment and meet the covenants they have with investors, so being compliant with that, is generally the EUA market. It is highly liquid. It has end of day marks. So that means you can mark your portfolio and what it's actually done during the day. And if there's ever an issue with needing to exit markets, you can find the liquidity to exit. So that means the only real place they can go is the EUA market. And as we know, that's trading in excess of 60 euros, call it around 70 US dollars, while high impact projects that are contributing significantly from an ESG perspective, high charismatic projects are trading many multiples below that. So we believe that once we can get capital markets participation in this market and we can give them the facilities they need to be in covenants with their investors, now we can start realizing true value for these projects. And that is also how we will get a lot more of these projects up and verified and transacting in the market to support ESG and the communities and environments that we're trying to work with. So again, increased liquidity and broader inclusion. The possibility to reduce risk profiles, I'll dig into that a little bit deeper in a second. Financial institutions, we'll discuss that. Mutually beneficial pricing opportunities that I will also dig into in a second as we go through managing price risk exposure. It assists corporates, boards, and executive leadership in both internal and external communication. And this is an important one because many corporates are at very different stages on their journey towards decarbonisation, right? And articulating that both internally to all of their stakeholders, to have them all join the journey together and understand what that means is extremely important. If it's not in people's KPIs, unfortunately, it generally is very hard to get across the line. So the more data we can actually bring to the table for that conversation, particularly around decarbonisation and ESG, which is what these projects in the voluntary carbon space bring, that's extremely important internally. Then once that internal discussion is moving, it helps them to communicate externally. And it's extremely important for their stakeholders. Now we are talking, take for example, a mining company. They have governments, they have local communities, they have their employees' families in many cases because they support rural communities. So the list goes on and on. Plus the mining community has a bit of a reputational problem, a bit of an image problem. So attracting talent to their organisations. They need to show that they are actually on point when it comes to decarbonisation and their ESG commitments. So it's very much a stakeholder, as we like to discuss it, not just investors. And by the way, investors are becoming a hell of a lot more acutely aware of driving ESG and decarbonisation. And I'll point you to follow the Transition Pathway Initiative, if you're not already, a guy called Mark Matthews, who is leading that. And they have around 20 trillion of assets under management now. So this is very much driven from big institutional investors on that journey. So it's in the interest of both boards and executive leadership to embrace what we're talking about. Stimulates desired behavioural change. That gets back to what we just talked about and many other derivatives of that. I know there were a couple of pings there with questions, but with Google Meets, I can't see what those questions were. So if you don't mind, I'm going to grab them at the end and we can have an open dialogue if that's okay with everyone. Because all I can see right now is my presentation screen. So I'm going to whip through it. Lessons from commodity markets. Look, that's what I've lived and breathed for 25 years, based in many different places around the world, physical and financial. I love the physical side of things. I love working with people. I see a lot of similarities with project development. It's fantastic to see what a lot of commodity companies doing the right thing, and they're not all doing the right thing, how they're able to work with the communities where they operate and the environment where they operate. And sure, there's a lot of challenges there, and a lot of them have done a lot of wrong things as well. But I see a lot of similarities in the human involvement. This is not an area where it is abstract, where we're removed from that. We want to facilitate that human involvement in the communities in which we operate. So commodities, I think, have a very high correlation to the evolution of this market. But just to go through a bit of a case study, price discovery and transparency is the norm in commodity markets. And anywhere there is opacity, yes, it gets squeezed very hard by those that are the privileged few, but that is recognised quite quickly, and then a push for transparency comes. So the normal flow, and I could have put this in a flow chart, actually, it would have probably been better, but we start with bilateral transactions with little understanding of supply and demand or true value, right? And so the buyer doesn't really know what the fair price is. The seller doesn't really know what fair price is. So negotiations are extremely difficult. They'll point to all different kinds of measures that might be similar, or this happened over here, but it's very difficult to come to a price understanding. But if the seller needs to sell and the buyer needs to buy that product, then a transaction will take place. But it's very opaque, right? And it becomes by nature confrontational under an opaque situation. So the next evolution generally is measurement, and a standard has evolved, right? So we might sort of look at a widget, for example, and there's many different sizes and grades, etc. We might start to gravitate towards looking at what is the most frequent transaction and what is the most frequent product that is transacted, and what does that look like, good or service? And then from that place, we can then start to understand what the relative value of our specific requirements are for the product or service that we're looking for. So a standard starts to evolve. That then evolves to something like an index, because through market consultation, the industry starts to understand in a deeper way what that measurement and standard actually looks like. So that gives you an anchor point, right? And then we'll show you how we've been contributing to that in a second. That brings price discovery. Transparency is exponentially increased. As people talk more, the industry starts to collaborate more, both buyers and sellers and intermediaries, those that provide services to the flow, for example, in freight or finance. So we evolve from then once we've got the index in place, we start to evolve from fixed to floating price and base negotiated. And that can be a little bit of a complex concept, but we'll dig into that in a minute too. But that is very normal evolution. So that then allows long-term offtakes, risk reduction. It then evolves into derivatives being available with highly correlated financial products to the physical, and convergence with the physical. And that's to say that if you trade a derivative product, you may have a delivery mechanism. So for example, if I'm a farmer, I'm farming corn, and the financial market suddenly starts to pay a lot more for that corn, then I will sell him that contract and I'll deliver him the corn in the middle of Idaho, right? So it forces convergence with the reality of the underlying contract. Again, a little bit sort of, it's an evolution, right? And we're at the start of this in the carbon markets, but just to show you where it can go. Importantly here is at each stage, each of these stages, when a market is established, like the grain markets, like mining, metals, any of these kind of markets, then the evolution generally finds resistance to change because people have done this for a whole career, right? And generally you have the seniors in an organization who they might be in the twilight of their career, and if it ain't broke, don't fix it, right? So you get a lot of resistance to any change. And I could give you many, many, many different examples. We haven't got time to go into that now, I think. But there is many examples, whether it be from many of these kind of markets. And I've lived and breathed that, and it's I've got bruises and scars to trying to fight that battle, because evolution is a good thing for these markets. So as the voluntary carbon market is relatively new, this is a significant challenge avoided, which to friends of mine in the commodities markets, that's a breath of fresh air, particularly those that think more entrepreneurially and think more about how we can really get the voluntary carbon market contributing to our decarbonisation and ESG. So fixed floating basis, I referred to that earlier. At the moment in the voluntary carbon market, almost exclusively prices are set as fixed price. Even if I'm looking at negotiating a 5-year offtake for avoided deforestation in Kalimantan, for example, then I'm going to talk and negotiate a fixed price with the seller. The seller wants certainty over price, which we understand. We also like certainty of the price. If you're a buyer, for example, because there's a lot of evidence that this market should head north in price, should head higher. So fixed price is good if you've got access to capital to be able to lock that in. However, what we do believe is that floating price builds a huge amount of opportunity into the ecosystem. For example, you could take that 5-year offtake from Kalimantan and you could do 75% fixed price. So there's certainty for at least 75%. And if the market does head upwards and you put 25% on floating price versus an index, which is what we'll get into in a second, if you put that, then each month that you're paying or each quarter, you're paying the market price. So if the market does rise from arguably, let's say $10 to $20 over time, then that project developer who's supplying those credits will get the $20 versus the $10, okay, instead of having had a fixed $10 for the 10 years. So great for the buyer in that situation. But then what if price goes to $5? Well, then the buyer is in an advantage to have it linked to an underlying floating price, but still with a commitment. So what that also does is that has numerous opportunities as we evolve this market. And I'd like to see, and I'm quite passionate and about the evolution because I've seen it happen in other markets and I know the value it brings. So the index floating price brings you also the ability to place volume, and each counterparty can manage its own view of the best value price over time. You can do a combination, as I just explained, 25-75. You can have it fully indexed, for example, 100%, and then go fixed price later. So there's many different ways you can then use this tool to benefit both parties in a transaction. And I think that would be highly, highly applicable for the voluntary carbon space, particularly for those that are supplying the credits, so they can participate and share in the upward trajectory of price that is anticipated. So different pricing methodologies, they affect risk differently as well. So as we discussed, a fixed price effectively equals high risk. If you lock in that $10, market drops to $5, buyer's in trouble. If you are on the production side and you're the supplier, you're the developer of that project, and you sell it for $10 for 5 years and it goes to $50, what an opportunity lost. And that could be an opportunity to fund a new project to save more forests or reforest. So we really want the project developers to be able to take a piece of that pie as well as it moves, particularly for longer term deals. Importantly too, counterparty performance risk. Now this is a major point in the voluntary carbon space, because if we're taking a 5-year offtake and say we've done $10 and the price rises to 50, how guaranteed am I as a buyer that that seller is not going to welsh or default effectively on supplying those credits to me. They're going to go to someone else in the market, maybe sell them to them, right, at a higher price, maybe even a discount. And I can take them to court, I can do all of it, but that will drag on for a long time. It'll cost us both a lot of money. But the developer in that case will make a lot more money by defaulting on the initial contract and recontracting with someone else. Okay, so counterparty performance risk is drastically lowered with floating price, because if the price does move to $50, that's what they're achieving. It's a floating price agreement, right? So they will achieve market price. And that's a very important component for the relationships being developed. And this is why I sort of wrote across here at the bottom, in any market, particularly in commodities, as one builds a project or business, we earn the right to grow and deploy capital, right? And we are we are very much at the infancy of this market growing, we believe. There's a long way to go. We're not even at teenage years yet. So, and by driving successful deals and robust risk management, we can then build integrity and credibility, because that's earned through reputation, through performance. And we maintain and grow through collaboration for long-term sustainability. So commodity markets have proven this over time. And again, we don't want to reinvent the wheel. We can learn so much by looking at other markets and replicating that into this market. So the solution we came up with, and that was basically the why, and in graphic detail, or more wordy detail than graphs, unfortunately. So then the solution we came up with, we've got to harness the technology available to us today, build transparency, and we decided to do that through artificial intelligence. So we've deployed that. And if you want to go into that in any further detail, please reach out to us, because it is kind of complex. What I can say is that we have a valuation risk engine. The model's been trained. We've got almost 30,000 data points of actual transactions that are feeding into our model now. And it's all well and good for us to say it, because you ask, who is Viridios? What are you guys? What's your credibility? How can you contribute to a whole ecosystem with transparency of price? Why should it be you? Now, that's where we go on to the next part. So this is just a little bit on the VRE and risk engine and the neural networks that sit behind it, but just leave that to one side for a second. We could dig into that more specifically in another conversation. This is why we believe that we have built the credibility in the market. So S&P Global Platts, and I'm assuming you're familiar with them, they are a huge multinational index provider. Going back to what we discussed earlier, they are a provider of transparency in marketplaces. They fundamentally agree with that as part of their fundamental values. And markets will look to them, and there are others out there as well. But this is one of the biggest in the market, with huge market penetration, huge diversity and inclusion across multiple commodity markets and other markets globally. So you're probably aware of their name. So we partnered effectively with them to provide the first ever indexes driven by AI. Now, they were pretty nervous about that because, again, first index driven by AI. So they need to understand very well who we are, what Viridios is about, and particularly what our AI is able to bring to the ecosystem and how reliable that is. Otherwise, there is no way that they would put their brand name in conjunction with ours. It's a David and Goliath. So we believe together we're bringing transparency to the voluntary carbon markets, and that's what we did. It took over 6 months for them to agree to release a MOU, a memorandum of understanding, that we were collaborating with this in view. It took a further 5 to 6 months until on the 23rd of August this year, only a few weeks ago really, we launched the first ever indexes that capture voluntary global carbon markets. There's 6 indexes at the moment. There may be more in due course, but those 6 are now on a daily basis being produced, and they give everyone in the ecosystem a place where they can go and look at a transparent and representative market price for different carbon credits that are grouped. And this is what that is. You can actually log on. You can go to, if you search for Platts CarbX carbon credits indices, then you will go to this page. I've taken pieces of it here because it's easy to present and you'll see it better. But you'll get to this page where you can then register for a Platts account for free. And you will be able to see this on a daily basis using your logins. So this is a service we are all providing to the industry because we believe in price transparency and what it brings to the ecosystem and helps us evolve. with the ultimate aim of really harnessing the power of voluntary carbon markets and offsets to contribute to our global decarbonisation, and particularly the charismatic components of ESG embedded. So we have household devices, CarbX. You can see the list of them there. I'm not going to go through them. There's a little bit there on what CarbX carbon credits indices are. You can visit to see the full methodology there, which explains in greater detail, and which would take a long time for me to do on a presentation. So I'll let you look at that if you like. Again, please reach out to us if you have any questions. You'll find us via our website. You'll find us via LinkedIn, and there's an email at the end of this as well. So these are the indexes that we see the industry gravitating towards that will fundamentally drive the evolution from fixed price to floating price. So you could anchor, for example, using the Kalimantan 5-year example, we could anchor on the Eco-Create CarbX Biodiverse if it's a highly biodiverse project, ticking off the SDGs that represent that. And if that currently is trading, let's say 1076, which we see there, that is the fair value. If that project is highly charismatic and you run it through our pricing system, which can help you define what the basis is, maybe that project comes out as being fair value at, let's say, $12 today. So therefore, you can negotiate a floating price Eco-Create CarbX Biodiverse Index plus, let's say you start negotiation at $1 as a buyer, as a premium to that. So if that price rises by the end of this year, you've secured the 5-year offtake, that price rises to $20, then the originator, the one who you've done the transaction with and bought off, the seller in this case, will be charging you $21 at that point in time. So they're able to take advantage of a rising market. If, however, that market was to fall to the Eco-Create CarbX Biodiverse Index fell to $5, then it would be in the buyer's advantage. I'd be paying $6 for that. The dollar premium as being fixed. That premium can be either fixed number or a percentage of the underlying. It's up to the negotiation. But as you can see from that example, it is that floating price which allows you to work together. You're both participating in the market, and neither of you are at a significant advantage or disadvantage as you would have been with a fixed price deal. And that gets back to also what we talk about, sustainable business, working together, collaborating together, because there's a bigger picture here that we're trying to solve, not just price. But price is a critical enabler of that objective. Market potential, look, we see this market growing. I'm sure you will have seen a lot of this in the New York Climate Week. There's a lot. It's hard to create a bearish argument, an argument for prices to drop. And look, we're not an advisor and telling you to go and invest in this market or to develop projects as quick as you can. But we believe that a rising price is good for all. The only ones it's not so great for necessarily is those that are consumers on the other end that may see the price of their energy costs go up a little bit. But at the end of the day, the challenge that the globe faces is far greater than that. And I think we're all part of the solution. We're trying to help as much as we can and enable that evolution as best we can, utilizing the core competencies that we have. As said earlier, we're not around to second judge we don't have the expertise, we don't have the resources and the expertise resources to second judge the accreditation companies, for example, and how they do that. We very much focused on bringing this price transparency to the market because we believe that is a step change in adaptation and adaptability, and bringing this as the part of the overall solution to the challenge that we face. So with that, there is some contact details. I'm going to now, but again, you can reach us very easily through the website or through LinkedIn. So I'm just going to shut this one down and I'm going to go and address the questions that we have. I hope that was useful. I thought I heard some pings there, so I'm not sure if there are any questions. Let's see. No, I don't have any questions in the chat box. I don't think. So I'd just like to open it to the floor. Hopefully that was useful for you. We put aside 45 minutes, I think, so we've got 5 minutes for questions if anyone would like. Otherwise, again, more than happy to chat about this. We're all pushing the same direction for the benefit of all. So I'm happy to talk anytime. But over to you, anyone. Just to take yourself off mute if you want to ask a question, or if there's anything confusing, I'm happy to put the slide back up, go to a specific slide if you like. Just let us know. How have we found Climate Week so far? So what I might do then, if there's not questions, again, look, you're more than welcome to reach out. Okay. Not sure how I get to that one. Somehow. Gwen, I've now got a problem because I haven't used Google Meet before. I'm now trying to go to the questions and I can't see it. It keeps pulling up my my invitation to Climate Week. Oh, now how am I going to do that then?
Do you want me to read out Gwen's question?
Yes.
Because I've got the message. So thank you for the question, Gwen. She says, my company assists communities in project development. How fair would it be for me to use this to show them potential income?
Right. Okay. Very good. Excellent. So Gwen, you could use the indexes, the indexes that you saw, the 6 indexes, and just search, S&P Platts, Carbex indexes. And then you'll be able to use those, and that will at least give you an anchor point for the conversation. But that number is based on a huge number of projects on a globalized basis. So if you're then looking for a specific geography, and that does impact prices, as you well know, avoided deforestation in Brazil, given their track record, especially under Bolsonaro. It was lovely to see his speech at the UN just recently. So under that, so Brazil is different to Indonesia, right? Or Peru, or Cambodia, so that will have an impact, right? But at least you've got a globalized anchor point to have that conversation. So that's how it works symbiotically also with our pricer. So with our pricer, and I can demo that for you if you'd like at some stage, or any of us can, that allows you to look at the specific project inclusive of the SDGs which you are helping develop as part of that project. Now, we charge for the pricer through subscription. However, what is important to us and important to the sorry, someone's decided is joining very late. But we're inclusive, so that's good. So if you want to develop a project and you've got transaction history, then we can do a barter arrangement on use and simulation using our pricer, which we normally charge for, right? We can use that as a barter deal to also. So if you give us transactional data, then we can allow you to also use that to help you understand true valuation of the project you're trying to develop. Now, importantly too, what that does is, because we can understand the value of each one of the SDGs via all of those transactions, what's been paid, that can help you decide which SDG to focus on inclusion in your project. So for example, if you're working on cook stoves in Rwanda or something, you're working with 6 different local communities. If you were to then invest in putting in a school and putting teachers in that school and keeping that school funded and keeping those teachers paid, you can have a look at what education inclusive as an SDG would give you as an increase if you're able to get that certified. So you'd need to check that with the certification company as well, to see what the standard is that they would accept. But then that will allow you to financially understand whether it's worth investing in that school. Look, ethically it is, but it also helps you to overlay a financial robustness around it, which also helps you then to go to financial players who can help fund those projects because you've done that robust analysis from a financial perspective. I hope that makes sense. Cool. Sorry, I couldn't read your question. Thanks, Marcus. Anyone else got any questions?
There's another question here for Ionia. Sorry, I cannot activate my camera. Which data are the index based?
Very good question. So the data sets are from 2012 onwards, but mostly from 2016. And look, that is a major core of our business and our offering, really. We don't need to know the counterparties to a transaction. We don't want to know, right? Because that's often under NDA. That's through the bilateral conversation that's gone on between the two companies that have transacted. All we need to know, and we've got people who give us this data because they believe fundamentally in transparency of price in the evolution of the market. And we have those that we do a barter deal effectively with, so they get access to our pricing tool and our simulation tool. And that's how we've managed to get over almost 30,000 data points of transactions now. Now, what we need from that is we need obviously the date of the transaction. We need the price. We need the underlying project. We need to know the geography of it, like which country it's in. We need to know who verified it, which verification company. We need to know the number of SDGs that are certified within the project, and ideally volume. But we're generally dealing not in the retail market, we're looking at wholesale market. So those numbers there that we showed for the CarbEx and also in our pricer are generated from the wholesale market, not from retail, like, offsetting your flight, for example, because that would skew the data far too much. So this data is robust, it's analyzed, it goes into the engine that has anonymity behind it as well. And so, yeah, that's how the data comes to us. That's how we negotiate to get that data. And a lot of people are very protective of that. So it's been a lot of hard work to be able to get that. And like I said, the deal with Platts would never have put their name to this, their brand, unless they had done all the work to be fully comfortable with our methodology, where the data comes from, how it comes, obviously with respect to our IP. But that's why that deal was so important, and we put our business on hold to be able to achieve that. Because that also effectively outsources the KYC and credibility. You can lean on the fact that Platts has worked with us to co-brand those indices. I hope that answers your question. If you have more, just reach out. Anyone have any more questions?
Andrew, just briefly, actually, maybe the helpful to understand also that in addition to the data, we have benchmarks that go into the artificial.
Yes, very fair point.
So that would be.
Yeah, that's a very good point. Thanks, Marcus, for reminding me of that. So we also have there's correlations with a number of very frequent data points that are out there in the marketplace all the time. So we also have correlations with the amount of CO2 in the atmosphere, Brent crude prices, the Fed rate yields. The EUA market has a correlation too. So those are produced daily. So they also feed into the engine as well. The engine's learning pricing behavior. And so this is how we come up with the fair pricing models. It's constantly learning and evolving. So we no human can get in there and tweak with it. And we're constantly making sure that it's correlated with the market. Nothing's gone haywire. Thanks, Marcus, for that.
We have a response from Ionia. She said, thanks for your answer. I have heard that an index from ecosystem marketplace could maybe also be created.
Yeah, look, I mean, you can create indices. There are others that can go out and create indices. We've had that. Look, I was in the iron ore market for a long time, right? In the iron ore market, we have numerous different index providers. You have Platts, you have MySteel, you have Argus, you have a whole range of them that are producing these indices. Fast markets as well. And what can happen is you can actually look at doing a combination. There's nothing to limit a combination. I mean, I've done contracts before, which are a combination. So let's say 70% of this index, 20% of this index, 10% of this index. And then that creates effectively a hybrid index, which is more representative of the underlying product or service, could be, that you're providing. So a proliferation of indexes is not a bad thing. It is, however, better if you can to anchor on one, because then it becomes the norm of the industry. And in this case, the ecosystem. Industry is not the right word for what we're doing voluntary carbon markets. I'm yet to find the right one, to be honest, but I use ecosystem, right? So if we can anchor on one, that is a lot clearer and a lot easier for the uptake. And obviously, we're partnered with Platts on the index, so we have somewhat of a bias from that perspective. But look, it doesn't preclude other indices and the value of other indices, right? They may be more appropriate for your specific underlying project, and that's fine. That's fine. I think what we're passionate about, what I'm particularly passionate about, right, is that evolution to that floating price, because that's going to help all of us so much to be able to keep projects properly priced, to keep them properly funded, to get more forests protected, more reforestation, more household devices helping families in poorer parts of the world, from every perspective. I hope that makes sense.
Yes, thank you. Finally, I managed to open my camera for the explanation.
Ah, yeah, we got you now. But if anyone wants any follow-ups, I mean, I'm just conscious we've gone over time now. I'm fine, but I mean, if you want to reach out afterwards, we're now at I think we're 5 minutes over, but that's fine. But I hope that answered your question. Is that okay, Ionia? Cool. Right. Anyone else have any questions? Any more?
Yes, then I've got another question. Is it how about the fees to get to the data to the index?
Okay, good question. The index at the moment is free, so you can actually use that index. You can go online. You can register at Platts. So again, just like search for Platts S&P Global Platts Carbex, and you can find the link to that. And from there, it asks you to register for a Platts account. That's free to do, and that will give you access to it every single day. Your organisation may already have a subscription to Platts, but if not, just go and do that, and you'll see that on a daily basis. And that can just help the conversation, right? I mean, whether you're a corporate, whether you're a project developer, whether you're in a fund trying to convince allocation of capital, that at least gives you an anchor point to have a conversation about price. So it's free for that. What does cost money, and this is going back to the conversation I had with Gwen just earlier, is that the pricer is on a subscription model. Okay, so look, we in Platts don't make any money out of the index. That is freely available at the moment. Again, it's a philosophical stand that we're making on that. What we do make money out of, and our business model is around the pricer, and that helps you define specific project. Now, but like I said earlier to Gwen, we are very open to having a conversation about contribution of data as a barter deal on access to the pricer. So I'll throw that out there as well. I'm not sure what part of the ecosystem you're involved in, Ionia, but yeah, we're open to those conversations as well.
We have a question about the pricer. They say that, she said, what about the pricer? How does she find out about the pricer?
Look, reach out to me or via our website. So just if you look up Andrew Glass on LinkedIn, you'll get my contact details. Just ping that to me, and then we can organise a time, and we can just book in a 30-minute Zoom if you want. We can make it pretty efficient. I can just run through the pricer for you and show you what it does, how it does it, and then you can take that away. Look, I mean, the interface, the front end, is quite simple and user-friendly. It's what's behind it, though, is the huge part. Oh, yes, thank you, Paula. There's my email address right there. I hope that answers the question. Okay. Any others? I'm going to stop the recording now, if that's okay. I think if I can work out how to do that. Anyway, it was a very good session. Thank you very much. Well, I enjoyed it anyway. I hope you guys did. All right. Again, reach out if you've got any further questions. But thank you very much. Have a great day or evening wherever you are in the world. And yes, onwards and upwards, the better of everyone.